Because again, like 2008, it wasn't really about subprime mortgages. They just happened to be where this thing started. It's the same process every time. So once the downside of the cycle hits, it does become self-reinforcing because every action leads to a reaction. It's a positive feedback loop where every reaction produces a greater response and then a greater response and then a greater response. And it just kind of spreads and filters out from there.
Yeah. It starts with Tricolor, and it goes to First Brands, and it goes to UBS hedge funds, and it goes to layoffs, and all these things combined. If you're a dealer bank, you're just seeing risk or counterparty risk just go parabolic. And so let's just say that you've got an extra $1 billion worth of bank reserves, is that going to really impact your decision-making process if you see risk going straight up? I think the answer is no. The example I use, I'd like to get your take on this, just to kind of try to keep it simple for people, is I always say, assume that you're a hard money lender, because most people can get their head around that. And it's you make money on taking a set amount and lending it to a real estate investor. Okay. And let's say that you've got $10 million. And let's just say that the housing market is declining, and therefore lending to these real estate investors is becoming more and more risky. Well, you've got one of two options. You're either going to increase your interest rate because you've got to be compensated for the additional risk. But most likely that increase in the interest rate is going to make it prohibitive for that person to borrow the money, because then the math doesn't pencil out, or you can just not lend. Now, is the problem that you don't have any money? Is the problem that you don't have enough money? No, that's not the problem. The problem is that risk is going straight up. So even if the bank comes in and says, hey, I want to give you an extra $5 million. Okay, great. I can't even use the 10 million that I already have. And then to make the example more realistic, we have to remember that the banks create their own money. They create their own credit. They create their own liquidity within the banking system itself. So I think that's the example I use for to try to illustrate why it's all about risk at the end of the day. And the QT, QE stuff, it really doesn't impact things mechanically, although psychologically, I think maybe there is an argument for the perceived counterparty risk going down, just because people think that if the Fed is doing something, then maybe that matters.
Yeah, there's all sorts of literature that's, the academic, the theoretical benefits of QE are, portfolio effects, psychology, and interest rates. And the reality is that all of these academic studies, they never really find any statistically significant effects in any of those, including psychology. Really? In fact, psychology is supposed to be the number one thing that QE does. It's not money printing. It's not bank reserves. It's supposed to, not just even the banking system or even the financial markets. It's supposed to have people in the real economy thinking the Federal Reserve is doing something big, and it's accommodative and it's stimulus. So I don't need to know what it is. They just know that the Fed is doing it. CNN or, CNBC or Bloomberg tell me that they're pouring trillions of dollars into the economy, which, by the way, is not true whatsoever. So they're pouring all this money in the I should start spending and investing and hiring people because this is going to help me in some way. That is the true channel by which QE is supposed to work.
Yeah, that was my point.
Yeah. So, but what you said, George, is exactly the case. And we have to keep in mind, in a ledger money system, as you were just pointing out, money is created and then lent into existence. So if to create money and I have to lend it to somebody, that means I also have to take into account the probability that I'm going to be paid back. So even if I've created money, I've created a loan, that loan doesn't get paid back. That creates a loss, an accounting loss that becomes a real thing on my balance sheet, which then creates all sorts of bad consequences for me. So even though I have this money printer that I can create ledger money, it is not risk-free, and it's not as easy as just printing money and then sending it off on its way. So you have to take into account the overall credit and economic climate that all this stuff takes place. So if you can create money, but you think, I can create money, what am I going to do with it? I'm going to lend it to somebody on crappy collateral that I don't even know. No, it doesn't matter how much money you have or have the ability to create money. It's the overall economic climate, which, by the way, is why economists and central bankers spend so much of their time and effort on psychology and emotion and sentiment, because sentiment is a real big deal. The problem is sentiment alone can never overcome previous stupidity. right? You can't just get everybody to think happy thoughts is going to magically erase, 4 or 5 years of epic stupidity. It's just not going to work that way.
Right. So your other option there is to increase interest rates. And I think that takes us right into repo. So do you want to explain kind of what's been happening with the SOFR rates and why that's atypical, and then go into the usage of the Fed's standing repo facility?
Yeah, so the Fed has a standing repo facility, which is really like the discount window, except with some features that make it a little bit different and more usable. So it's basically supposed to be sort of a lender of last resort. Repo, for people who don't know, is just secured, collateralized interbank lending between counterparties. So it's supposedly the safest interbank lending in wholesale market that's out there. And it really is. I mean, for the most part, there's really not a whole lot of risk in lending treasuries. Your biggest problem is getting the treasuries back when you have collateral shortage. But repo markets are huge. You also have to keep in mind, I point this out all the time, that there is no single repo market. There's several. And we really don't know what's taking place in the majority of it because there's no information. There's no real tracking. So the information that we do have it's sort of a proxy for what the overall repo market is.
Several repo rates too, aren't there? Yeah, like each counterparty has its own repo rate, and then we just take an average, right?
That's what I'm going to get into next. So there's not a single repo market, and there's not a single repo rate. The repo benchmark that the Fed comes up with, SOFR, the Secured Overnight Financing Rate, is not a single rate either. Just like federal funds is not a single rate. Mm-hmm. There are many different. There's hundreds of thousands. I'm probably not that many. There's thousands and thousands of transactions that take place every day in repo, and so the Fed kind of it looks at all the transaction data and says, what is the weighted median of all of these transactions that take place? So there's a dispersion, and it can be a relatively wide dispersion in the marketplace. What has been happening over the last couple of months, really going back to July, is that repo rates have been creeping up more so at the top end, which means that borrowers who are judged to be either too desperate to borrow funds, or they have less good collateral that they're presenting for to be posted as collateral for their arrangement. The market has been tightening up and tightening up and tightening up. But part of it is too, there's just less cash circulating through the system, which is what George's point is getting to be. That money dealers who are responsible for relending and recirculating funds, not necessarily bank reserves, it's also private ledger money. So recirculating funds through repo, they're less willing to do so. So those who have cash in the system, alongside those who circulate the cash in the system, are both increasingly, don't want to make too much out of it, but they're increasingly risk averse. They're increasingly pessimistic about all sorts of things, not just in the repo market. So things have tightened up. The money suppliers have made less money available in the marketplace, and the money circulators, the dealers, have made less money circulate through the marketplace because there's risks to doing both of those activities. Right. And as the perceived risks rise, they want to do less of them because, as George said, the only way around that is to charge a higher rate, which is what we're seeing in the repo market. So repo rates have been creeping up a little bit, and they actually they got a little bit out of hand toward the end of last month into the early part of this month, which suggests that there's something going on, some monetary tightening in this key wholesale marketplace called repo that suggests that there is more to the story than just quantitative tightening or just an overall benign environment where everything's just completely fine and this is just a bunch of technical matters.
Mm-hmm. And I think it's funny when you say George, it sounds like we're someone else is asking you the questions and we're just splicing this in, but we're doing this live, guys. I guarantee. But that takes us into, I think, another topic of discussion, which people get very confused and actually people get angry about. And that's why deficits and debt expectations don't really impact interest rates, but growth and inflation expectations do. And because about a couple minutes ago, you're talking about how that a bank or financial institution, they have some options there. And if risk is skyrocketing, do they really want to take on that counterparty risk that entity isn't going to pay them back? So if they want to expand their balance sheet, the other option that we didn't talk about is buying treasuries, where you don't have to worry about that counterparty actually paying you back. And that's going to impact yields. That's going to impact the curve. That's going to impact a lot of different things. But that's really what's going to drive the decision making. It isn't necessarily going to be the bank saying, well, the counterparty risk is going up. I could lend into the real economy, but or I could lend to treasuries, but there's no way I'm going to lend to the government by treasuries because the deficits are going to explode. Because at the end of the day, they don't care because they're just pocketing a spread between the liability side of their balance sheet and the asset side of the liability balance sheet, or excuse me, the asset side of the balance sheet overall. So can you kind of explain that and then tie it into what we were talking about?
People do get angry about it, and they get angry about it for the right reasons, right? The federal government is absolutely insanely broken. It's getting worse. It's not getting better. The problem is people immediately think, because they're told repeatedly by everybody, that this is a problem for the Treasury market. And it's not a problem for the Treasury market. It's a problem for everything else, but it's not a problem for the Treasury market. And if the last 20 years of absolutely insane borrowing didn't disabuse people of this notion, I mean, at this point, it's just ingrained in there. And I think a lot of it has to do with everybody hopes that the Treasury market will blow up because nothing else is working. Nothing else is getting it's a bipartisan problem. It's not a Democrat or Republican problem. They both do it. So if the parties aren't going to solve this for themselves, then the Treasury market has to blow up to put a stop to this, because this is just utter insane madness. And it is. The bigger the federal government gets, the more the government is going to interfere in everything because it has more money. It has more ability to influence everything. Right. That's why people get so angry, and they're absolutely right to get angry. But it does not follow that the Treasury market will necessarily blow up because of the federal government deficits. And that's the part I think that people, if you're thinking rationally about everything, then it's much easier to come away from the emotional aspect of it. Just to compartmentalize for a second and say, okay, this is what we would like to happen. It doesn't necessarily mean that's what's going to happen. And the reason is because, as you just said, George, if you're a financial person, if you're a financial manager, a reserve manager, it doesn't matter what, you're managing money, and your alternatives are a bunch of risky assets over here. If you're a bank or just an investment fund, it doesn't really matter. You got a bunch of risky assets over here, and you've got a bunch of perceived safe assets. By the way, safety isn't necessarily credit risk. It's the fact that if I sell this asset, if I have to sell this asset tomorrow, will I be able to sell everything that I want to at the price that I want to? The reason why treasuries are considered the safest instrument is because they have the deepest market. They have liquidity characteristics that are second to none, and even those aren't perfect. But that's why treasuries are the preeminent safety instrument. So if your alternatives are to lend into credit markets that may be on the downswing of a credit cycle with epic stupidity embedded in it, or just parking some money in treasury bills and getting, a couple percentage points while you still can, or maybe even shifting further down the curve and say, hey, the 30-year bond here at almost, 4.5% or 4.6%, that's looking pretty good. If things continue to go badly, maybe I should lock that in here. The alternative makes sense. You're not thinking about the government paying back its loans because it doesn't necessarily need to pay back its loans. It never really has. So you're thinking about the credit profile of the federal government. You're thinking about as you said before, the growth and inflation expectations in the real economy, what those means for the overall marketplace over the time period that you have as an investment horizon. So whether that's a couple years or 5 years or maybe even longer, you're thinking, if the credit cycle has to go in the wrong direction, I don't really care about the returns in the treasuries. I'm going to get some percentage point return for the next little while. I'm just going to sit myself in a 5-year treasury and not really worry about, the federal government deficits. Doesn't really matter to me. I'm more concerned about the risk that's taking place, or the reality of the downside credit cycle that's likely to take place and get worse as we go forward in time. So the marketplace is completely detached from the idea that federal government deficits are going to be some major problem at some point. They may be. There may become a time when that's a big issue, but that's so far down the road that it's not even worth considering for people who are participating in the market today, which is why you have these inverted curves. What the inverted curve is saying is that all these people in the marketplace, not just banks, financial counterparties, wealthy individuals, doesn't matter. They're willing to take less of a return for a longer run treasury because they know, or at least they're reasonably sure, they see the probabilities of risks becoming more than risks on the risky side of the ledger.
So the pushback there is going to be, right, Jeff, but at some point, this is all going to unravel because if the economy is deteriorating, if the stock market is deteriorating, the labor market's deteriorating, we could go into a 1970s type thing, and you're not going to buy a treasury at 4% because you know that inflation is going to go up to 10% or 15% or whatever, and your purchasing power is actually going to decrease. So there's no way you're going to buy a treasury in that environment. So you're likely going to buy gold, or you're going to buy silver, or you're going to buy Bitcoin, whatever they insert into the equation. The way
But that,
I
I mean,
like,
that assumes that everybody agrees with you, right? You're assuming that inflation is happening when nobody else agrees with you. The marketplace says, I don't see any inflation. You may see inflation, but you're wrong, because the market says, I don't see any inflation. And by the way, that's not why gold is going up, and that's not why Bitcoin is going up either. So people are inferring from these market signals what they want to take away from those market signals. They say gold is rising. That must mean because 1970 style inflation is coming. Well, gold was rising pretty sharply before the 2008 crisis too. And everybody at the same time said the same thing. They said, oh, look, inflation. And then when oil prices skyrocketed, they said, see, it's 1970s all over again. And what happened? We had the 1930s.
we did have inflation. I mean, to be fair, the CPI from
No, but
the
that
end of
wasn't
07.
not inflation. That was
No,
not
but you had the
inflation.
CPI, but you had the CPI go up. The CPI
Yeah,
went from 3.6
but
to
that was a
5.5
misleading
or so.
signal that fed into all of these biases. People thought that it was that what they were talking about was that gold was signaling, like what you were talking about, an era like the 1970s where inflation was going to be out of control and a persistent problem that was going to lead to the debasement of the currency, right? That's what everybody said when gold was going up in 2005, 6, and 7, and even into 2008, though gold had a little bit of a problem there with the deflation. It's the 1970s all over again, but it wasn't. It was the 1930s all over again. So what I'm saying is the actual marketplace where interest rates are traded, the most sophisticated market there is, the biggest markets there is, they are uniformly saying that interest rates are going to go down and go down by a lot and stay there for a long time, which is the opposite of an inflationary environment. So people who are convinced that we're heading into an inflationary environment have to realize that the entire marketplace, the entire monetary system disagrees with that assumption. And so if you're understanding that, you look at gold and say, well, if that's not the case, if we're not heading into 1970 style inflation, why is gold going up? And I just answered the question for you. The same reason that gold was going up in 2005, 2006, and 2007. People were using gold as not in a currency alternative to shelter from inflation, but as a safe haven asset to shelter from the downside of a credit event after epic stupidity had infected the entire global marketplace at that time. Gold wasn't going up for inflation. Gold was going up anticipating deflationary circumstances, which is, by the way, what we got. I think what the problem most people have is they're not interpreting these signals in the way that they should be interpreted. And a lot of it has to do with just all the junk science and junk economics that are out there. The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those 4 economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.